Hey everyone, welcome to another live Q&A. I've been meaning to do one of these again. I think the last time I did it was 2 or 3 weeks ago, something like that. But anyways, let's go ahead and dive into your questions. I made a community post a while back right here from the view. Actually, this is a view from the right at the beach where I used to live, right next to a well, I guess I still kind of do on Lake Michigan. Um, but this was a view basically in the backyard of my house, practically, and it was really awesome. Just a cool picture of the skyline in the city of Chicago, so that's fun. Um, but anyways, I asked you guys for your questions, so I'll address those. And of course, if you guys have any questions you want me to address, you can go ahead and put them in the chat if you didn't have a chance to put them on this community post or you by chance missed it. If you did happen to miss it, try hitting the bell notification on my subscribe button, since that you should be able to get any notifications when I put out community posts. Usually I'm asking questions or doing polls and fun stuff like that. So if you guys don't want to miss those, be sure to have the bell notifications on. Oh, looks like we have some lively activity in the chat here from Brad Kellner, the stock compounder, and Investing with Tom, two of my buddies over on Punch Card Investing. We just did a show last night, Chicago time. Maybe what it would have been this morning, or it's real late at night, I think, where Tom's at. So that's always fun. Um, Anyways, go check that out if you haven't already after this stream, of course, because I need that watch time. Uh, Anyways, let's get into these questions, and then I'll bring it back to the chat every now and then. Tech here. I don't have any questions at the moment. Oh, okay. But I wanted to say your content is amazing. I know a comment previously wrote something similar to mine, but I love your no BS, authentic and straightforward attitude. But you know what? I love that. Thank you very much. I appreciate that you appreciate what I'm doing here on the channel. Since I do enjoy doing it, and it's that much sweeter when people get value out of it, or they just enjoy, even if it's just pure entertainment. Hey, that works for me too. So thank you very much. Keep it up and don't change when you're at 1 million+ subscribers. Wouldn't that be something? That would be super nice. We'll see what happens. I'm just taking it one day at a time, making content that hopefully provides some sort of value, or at least I'm trying to. And if it doesn't, I was trying to improve that too. So it's all you can really do. And I do enjoy the process. So that's always good. So thanks, Tech. And thank you for your consistent support as well. RK asks, would love to hear your experience on alternate real estate options like crowdfunding. Sorry, would love to hear your experience on alternate real estate options like crowdfunding sites such as Fundrise. Are they a legit, viable option? They're definitely legitimate. I do have a Fundrise account. I've had it for uh, probably 2 years now. The returns have been a bit lackluster, and I think the allure is that you're getting into private real estate, and you're going to be able to have these outsized returns compared to the market. But typically, it's kind of that institutional level real estate. Most of the time, I'm speaking very generally. You'd have to look at the individual investment. Uh, but I would just say don't expect to have massive outsized returns with a lot of these platforms, since they're usually large, rather expensive deals, sometimes really depending on appreciation rather than just straight cash flow. And if you're really into real estate, I don't know if I'd want to have a lot of my money tied up there. I'm really considering closing my Fundrise account. Um, though I kind of want to keep it almost as an experiment at the same time. I only have a few grand in there. But that could be useful towards some other project in a deal that I own personally. So, or something like that. So it's definitely legit. It's definitely viable, but I would just say don't expect to have massive returns, because it's not a deal that you're controlling, and it's typically something pretty kind of A grade. Like you're not going to have a ton of volatility, one would think, but you're also not going to have massive outsized returns, one would think as well. But it totally depends on the investment package too. So yeah, just tread carefully with any investment. Of course, look at what you're getting into. The liquidity it tends to be a little bit less with something like a Fundrise, where your money might be tied up for a certain period of time, or it's not easy to sell. So keep that in mind. But the deals they're buying, at least from what I've seen, it's usually in hot markets, pretty expensive. You're getting some cash flow, but not a ton. But you should get decent appreciation, maybe. But I never really like betting on appreciation personally in my own portfolio, anyways. So I don't know if it's really for me. Maybe that works for you if you don't really care to invest in real estate yourself, but want to have a little bit of diversity there, some specific deals that you're buying into. Sure, go ahead and knock yourself out. it is legitimate, and you can make some money doing it. So good question though. I had the same one when I was kind of looking at different options. There are other ones besides Fundrise. That's just the only one that I've really used. Um, and I don't, and I'm sure I think CrowdStreet is another. There are others out there that are worth looking into. I don't know which one is the best if there is one, but yeah, just take a look. There's definitely some value you can get out of those. Just don't expect to beat the world with them. But I guess you can say that about a lot of investments. Tom, thank you for all the truthful and no BS content. Oh, thanks, Tom. You and tech, you guys give me props. I love it. You should comment more often. I appreciate it. Loved your video on lifestyle inflation. Did that one a couple weeks ago, talking about kind of using lifestyle inflation as a sort of motivator where you're by buying this property. It looks like my internet is dropping a bit, so sorry if my picture quality is down. Hopefully not, but generally it was maybe I should invest in a bigger internet package to help that lifestyle inflation or something like that. But it's using that as a motivator. You buy a bigger house, but you always have that backdrop of being able to rent it out. So it's not as though you're over leveraging yourself, but you are enjoying kind of the fruits of your labor while you're building the portfolio. It's just food for thought. Trying to create a sustainable wealth building practice is really the whole idea. Anyways, here's a few questions. So this article, I don't have a New York Times membership, so sorry if I can't pull it up, but I got to see some of the article, and it generally was about the U.S. defaulting on its debt, potentially the U.S. government, which I frankly think is super unlikely that would actually happen. It's always used as a political bargaining chip, especially now with the whole debt ceiling argument that you're seeing play out in Congress. It's used as a bargaining chip more often than not. If the U.S. were to just straight up default on its debt when it controls the money printers through the Federal Reserve and also controls taxes, it's like that would be pretty crazy. At least if they were to do it now, given the amount of spending that they've been able to do in the last year just by printing new money, essentially taking out debt and then selling the debt to the Federal Reserve. They're probably going to do that for quite a while before they ever actually default on it. And in the current administration, it seems like Republicans would use it as a bargaining chip to get what they want, saying, hey, we're not going to raise the debt ceiling and threaten default if you don't service the debt. But what will end up happening, as it always seems to happen, at least what I would guess, is there might be a short government shutdown. Seems like we have one every few years when this happens. And then that shutdown will end. Both sides will get something that they want, and then we'll go back to spending like a drunken sailor or something like that. that would be my guess on what's happening there. So I don't think it's likely that they'll default. The media always plays it out like, oh, I don't know, sound the alarm, just going to be a default. I mean, the real default that we'll probably see would be printing away the debts and destroying the currency. Before you actually had just straight up not paying the loan and telling everyone to go take a hike. That just seems very unlikely when the US is in the global reserve currency status where it has a lot of flexibility to print a lot more than your average country might because there's just so much demand for dollars, whereas some other currency might not be have as much demand. That's a bit of a tangent, but that would be my thoughts on that issue. I think it is overblown. It's not that it's not serious and that the debt is kind of unpayable as it is, and you got to take some drastic measures, whether that be more money printing. That has everything's going to have consequences, and it's not going to be pretty. It's just kind of what route you get to actually pay down the debt eventually. Money printing, drastically reducing spending and raising taxes, so austerity or default. Those are the three options. The most attractive for a country like the U.S., which has global reserve currency status, I would think would be number one, in that you print away the debt at some point. But it depends on a lot of different factors. So we'll see what happens. I think from an investment perspective, you shouldn't let that drive your decisions too much. You should definitely pay attention to these things because they can change kind of what's available out there. But you really should be focusing on your individual investments, the merits of that specific position, rather than only looking at like the macroeconomic position, because there's a lot of things that push and pull that, politics being a big one. So yeah, that's what I would say there. Good question though, because it is a relevant topic nonetheless, given that the U.S. debt is like $28 trillion or something absolutely absurd. I think when I was a kid, it was below 5 trillion or something like that. And that seemed outrageous. And look where we're at now, or something like it's just amazing how quickly that things just really blew out of proportion, especially over the last couple of years. And both parties do it. Both parties love to spend in one way or another, whether it be raising spending and raising taxes, or cutting taxes and raising and keeping spending the same. It's kind of the dichotomy we got now. Neither party will balance the budget. That is my pessimistic take. We'll see. Maybe something will change in the near future, but oof, that'll be a big shift. Tom also asks about short selling. Do I do it? No, I don't. If so, how do you identify potential shorts and useful books you recommend? I don't. Um, and that's because the risk reward trade off just it doesn't make a lot of sense to me. In that you're taking full risk that you could lose your entire position, or if you really leverage out your ears, you could lose more. But that can be kind of hard to do. So the most you could lose is, or excuse me, I'm getting that backwards. The most you could gain is a double. So you could double your money because the stock goes down to zero, and you shorted the stock, so you then buy the stock back at zero and give it back to whoever lent you the stocks. So then you get a 100% return in a best case scenario where the company folds. But on the flip side, the most you can lose is infinite. If the stock just keeps going up and up and up, you can lose many times your money until you close the position, or until you run out of money to pay the interest to keep that position open, and then you're forced to close. And that's like part of like what happens with short squeezes, for example. It gets to a point where it's like, okay, when do you just cut your losses and move on? And it destroyed a bunch of funds, or like during the GameStop short squeeze, for example. You had many years of profits just decimated by a relatively small short position, but because the downside is infinite, because it's leveraged, you're in huge trouble if something goes awry from a short perspective. So I don't do it because the trade-off just doesn't make a lot of sense from a returns perspective. People can make it work. It typically would take a lot of due diligence and really just a massive kind of cash reserve to pay the holding costs of these positions, because you're paying interest on holding the borrowed stocks open generally, or hefty fees. And you got to be able to cover as well in the event that something bad happens, and without having to sell off all your other positions. One would hope. So I don't do it. I guess if you're trying to identify potential shorts, there are some good kind of short focused firms out there. One of them, Muddy Waters, they look a lot for like more accounting fraud type stuff, rather than just saying like this company's going to fail. It's more like, all right, this company's actually lying to you, and here's how. And because they're lying, this is going to catch up with them. That's kind of their general thesis. They find a lot of stuff in China, for example. That's one of their big focuses. Carson Block, the fund manager, is a Chicago Kent alum where I went to law school. So he went there as well. I don't know, whatever value that gives, but that's how I kind of first heard about him. Like, oh, and he's a relatively well-known short seller, of course. Muddy Waters is the firm that puts on a lot of these research papers. So I guess that's what I'd say there in short selling. Not massively knowledgeable on the subject, because frankly, I'm not interested in it, given the trade-off. Market cycles is your third question, Tom. Is it part of your investing process? What material, if any, do you recommend on the subject, other than Howard Marks's book? So this kind of gets to that macro micro thing we were kind of talking about with the debt default situation. I pay attention to market news, mainly like kind of monetary macroeconomic news, partly because I think it's interesting, but it's not like it's my first consideration, and I don't think it ever should be, unless maybe we're in a hyperinflationary environment or something, and that's all you can really worry about. But we're not in that, thankfully. But the way I look at it is, I do want to diversify long term, because if anything that we've learned in the last year, it's that no one country is invincible, no one investment is invincible. The currency certainly is not invincible. and you just have to cover your bases once you start building a substantial amount of wealth. I'm still very early on in the process, so it doesn't make a ton of sense to focus too much on defense. But long term, I'm definitely thinking about it a lot. Um, so I think as my portfolio grows, as I get in a better financial position, I will probably look more towards diversifying investments into other countries, potentially getting a second or third passport type of deal, um, and just having my options open, getting real estate in other countries, different real hard assets as well, not just financial assets. Uh, that's kind of where I'd be leaning when it comes to sort of cycles. I wouldn't try to time the cycles, but I know they're coming. And you have your general business cycle where it's kind of a boom bust and that's kind of it. But there's also these long-term debt cycles, monetary cycles that it seems like we're kind of getting closer and closer to the end of dollar dominance. And there might be some sort of paradigm shift pretty soon. And that has me a bit worried, but not worried enough to just, stop investing, put all my money in gold and put it in the ground. I'm not doing that. I'm still trying to build wealth in mainly through real estate, using a lot of leverage in the meantime, also focusing on my career, making money there. Ideally, turning YouTube into a revenue stream would be fantastic. But that's not something I'm counting on either. It's just I'm always trying to take some risks here and there, whether it be time risk or actual monetary risk, putting money to work. Uh, and that's kind of all I can really focus on right now. Just try to find a way, look at the individual deal, even if there is a worst case scenario where we get a blow up, real estate drops 50%, would I at least be okay? Could I float for a while? Could rents still make up make the mortgage payment because it's fixed? Even if property values have, would you expect the rents to have as well? And that's where like looking at the individual cities as well makes a lot of sense. So every deal is going to be different. That's in real estate or in stocks. So you got to focus on that first. Even if the macro situation is terrible in a city, for example, it doesn't mean that there might not be some good pockets that'll still do good even through bad times. Even if the general city is shrinking, for example, it doesn't mean that all the real estate in the city is terrible and you shouldn't invest in it. It depends on the individual deal. So again, you got to really focus on micro first when you're investing, and then macro is kind of like the border. It's like, okay, now that I've got the fundamentals of this deal down, any other considerations to make, then you might factor something in there, how you might weight your overall portfolio. But the individual deal should be supreme. So that's what I would say there. I hope that answers that question. I'll take a look at the chat here for a moment before we get back to these remaining questions. Oh, here's Brad. When will the rest of the world decide the U.S. is no longer worthy of the global reserve currency? We're just talking about not trying to time the market. The thing is with like debt cycles, with monetary cycles, these are like 100 to 200, 300-year processes. And even if you're off by only 5% in your prediction, that could be a span of 20 years. So it could be after I'm dead. It could be in the next 5 to 10 years. It's very difficult to say, partly because it depends a lot on what the government does, and trying to predict what the government does, like with any sort of precision, is pretty difficult to do, because you're inherently relying on the will of the people, and then the will of politicians as well, which they'll tell you one thing and then do something else a month later, and like it's very hard to predict a lot of the time, at least with any precision. Again, you can kind of get the general trend. Like I can tell you with decent confidence that the US government will continue to spend more money than it brings in, and that's not going to be good for this situation. But I don't know how long the government will be able to do that, because it kind of depends on what everyone else does. Uh, and it just kind of depends on how long they can keep doing that and how long other countries put up with it too, since you're relying on them too. Uh, any country right now could call it quits on the dollar system if they wanted to. It would have some serious consequences, but technically there's nothing stopping them from using dollars if they really wanted to stop. There are some economic incentives, but that's just like a bonus. So if I just had to like throw a number out there, assuming the government maintains its current course, not very long, probably a decade or two. But again, it depends on a lot of things. And that's assuming like no change, but of course there's going to be a change. There's going to be some other factor. There's going to be something that happens, maybe some innovation that drastically reduces the cost of everything, and it kind of delays some of this inflation or something like that. A lot could happen that I couldn't even begin to imagine. that could delay this, assuming it's even inevitable. It might not be inevitable. History would suggest that it is, but again, you never know because there could be some sort of fundamental change that kicks us out for another 400 years. Who knows? So yeah, I'm not getting too hung up on deciding a date, but once I get the means, the financial means, and it makes more sense, I'm going to start diversifying out of dollars, out of the U.S. economy into other countries throughout the world. That would be what I'd want to do a lot more once I get more defensive in my portfolio allocation, at least on the personal portfolio side, but not at that point yet. Good question, Brad. Show us some dance moves. Uh, Not right now, Tom. I'm in my office. I don't know what I do from this chair. Brad says, "Promise you'll still collaborate with Tom and I when you're at 1 million subs." Well, of course. And frankly, you first off, you guys are way ahead of me at the moment. Brad just crossed 10,000. Tom just crossed 30,000. So they're clicking, which is fantastic. Go check out their channels if by chance you haven't already. After the stream, of course. But I'd imagine because of our punch card joint venture that if I were to suddenly reach 1 million way before you guys, that's going to pull punch card up and therefore pull everyone else up. So we're all helping each other here. There's a lot of push pull factors. Thanks to our joint venture on punch card, which is a very good time, by the way. So just because I enjoy doing it, I would want to keep doing it. And that's assuming this even happens well before you guys, which who knows what'll happen. We're at the whims of the YouTube algorithm. Thanks, Rage Thor. Road to 1 million, man. We gotta hit 10,000 first. we're on our way. Another one from Rage Thor. Have you ever thought of starting your own business, possibly in the future? Well, I would consider not only this YouTube channel a business, especially because I've literally hired an editor and he's been editing almost every single video, at least for the past few months. So uh, I'm definitely treating it like a business where I'm looking at the long term, trying to now that it's actually bringing in some income, not very much at all. If I'm talking about a few bucks a day, which is great. It's far better than the nothing I was doing it for before. But now I have expenses in actually uh, buying equipment, paying an editor. So there are a lot of things that go into it, and I'm treating it like a business. So that's one, but it feels a lot more like it's kind of like a hobby and a business at the same time, which I guess is the best kind of business, one that you actually enjoy doing. So there are a lot of intangible benefits to like actual financial knowledge, staying up to date with potentially relevant events that are really more like potential opportunities that come up that might go away if I wasn't paying attention to them. So uh, there's a lot of value there too. But that's one. Then there's also my real estate business, and I treat that like a business as well. For my Indianapolis property, for example, I don't touch it. I have a property manager run things, and I have to check in with my property manager. It's in an LLC, so I have to treat it like a business anyways. If I want to keep that any LLC benefits. Um, and I'm definitely treating my long term real estate business seriously because that's going to be probably where I produce the most amount of wealth, or at least it's going to have the greatest impact on my financial future. Is my real estate portfolio, at least for quite some time, unless I have another business take off. So, um, otherwise, I'm not really considering other businesses besides that. I've mentioned starting a nonprofit at some point post financial independence when I could focus maybe more on a nonprofit housing venture or something like that. I think that would be really cool and a lot of fun, and potentially a great way to build a lot of connections and just make a big impact. So that's what I'm looking at kind of longer term is a nonprofit business of some sort, raising money for charity, looks like my own charity ideally, and then running like a nonprofit housing that could be the charity itself. So that's kind of what I'm thinking there. But otherwise, focusing on the real estate business and then also the YouTube channel. Frankly, if I'm focusing on a bunch of other ventures at the same time, given that I still work full time, it's not gonna be very fruitful, I would imagine, and I would probably just be hurting everything else at the same time. So I got to focus my time somewhat because I'm stretched pretty far right now. The only way I could continue to stretch would be if I hire more people, and I got to do that very carefully. Trying to think anything else there on the business front. I think that's all I'd have to say there. So yeah, good question. Brad asks, "What impersonations do you enjoy performing?" But after punch card investing episodes, we generally chat for a little while, and um, I won't. I'm not going to do them here, but maybe I'll bust them out on punch card when it makes sense. But I like doing kind of casual impressions, just for. I don't want to hype myself up too much. They're not that great, but anyways, I'm going to move on from that one. I shouldn't have displayed it, Brad. Cabbage eat, cabbage eat. How do you handle money in your relationship? Let's see. Where do I start? Because I met my wife when we were 18, we didn't really have much of a financial kind of situation yet. So we were able to kind of start fresh, which is great. Once we knew we were going to get married, we started joint bank accounts. We still have our own personal accounts that we like feed just a tiny bit of money into every month when paychecks come in. But otherwise, we pretty much share everything. Everything goes into a joint account. The vast the way we kind of have it set it up is we have like one master sort of flow through account, and then that gets siphoned off into a bunch of different accounts, whether it be investments, savings for investments, spending. We have like a vacation sort of restaurant account that a small portion of our income goes to. Yeah, that's kind of how we do it. We try to automate as much as possible, but otherwise, we're pretty frugal together. We we do a lot of our own cooking, so that saves a lot of bit of money there. But we also enjoy cooking and spending time together there, and it's always nice having a nice home cooked meal. And my wife's definitely been doing more of the cooking over this last year. It's kind of like I think during the first couple years, at least once we got into college, I was doing way more of the cooking, but it's kind of shifted since I've started my new job and was finishing up law school, uh, and she enjoys cooking too. Anyways, so we spend a lot of our time there, kind of talking about the general relationship more than just the finances. But in general, because I keep tabs on everything, like via the YouTube channel, like if anything's ever unclear, like for my wife, she can check out literally any of my content, like which is kind of weird to say, but like not really check out my content, but like I have everything prepared already, so I can show her right away, like our net worth statements, for example, and that sort of stuff. Um, so that's kind of we just kind of keep each other informed. She's focusing on school a lot more right now. I definitely handle way more of the finances, but she's definitely plenty responsible in her own right, and she's pays attention to what she spends too. So overall, I can't complain at all. It's great having a conscientious a wife who doesn't go and spend all the money or something like that. She's by no means like that, and it's fantastic. She's very intentional with how she spends her money, which is great, and it's all you can really ask for out of any partner. So that is fantastic. So far, so great. Um, it's a team effort, I guess, is the umbrella answer there. Tech asks, "Do you think the recent drop in crypto is related to Evergrand's crisis?" I mean, maybe some of the pullback is related to Evergrande and just about every financial market. For those of you who don't know, Evergrande is about $300 billion in debt that it's looking like they're going to default on all of it at some point. They've already defaulted on it, or not defaulted. They missed a coupon payment for some foreign debt that uh, they have 30 days to figure out before they officially default on that loan. And the Chinese government and the central bank there are saying that they're not going to be bailing out Evergrande, which is nerve wracking to say the least for the Chinese real estate market, since they're a massive real estate developer, the second largest in China, with like just billions of dollars of real estate. Well, maybe not anymore. They sold off a lot of the real estate to get their debt levels down to meet Chinese demands, or the Chinese Communist Party's demands, to try and deleverage a bit. Because China itself, its companies are relative to the U.S. extremely indebted. So they kind of wanted to combat that, and in doing that, they sort of started this spiral where Evergrande was selling off lots of their nice properties in an effort to bring their debt level down. But because they're releasing so much supply into the actual economy, it would move prices down with it. So it's kind of created this spiral. Um, and there's other companies doing the same thing at the same time. So, in essence, it seems like they kind of enticed a debt spiral in itself, and now we're potentially about to face the consequences, and we'll see what happens there. It totally depends on how the government reacts. If they get bailed out in some way, whether that be by the government or some group, we'll see what it actually happens. But to your question about crypto, the Chinese government also did like their 500th mandate saying that like you can't use crypto and it's bad because they don't want to relinquish control, I guess. Um, and that seemed to cause some sort of dip in crypto. But I mean, the cryptocurrency market is so volatile. It's like if you recall how much Elon's tweets were affecting it some time ago. So like any one factor can affect them so drastically because there's so much speculation going on right now. There are some fundamental kind of hodlers who are have probably better arguments for as to why they're holding it, but there's a lot who just go in for short-term profits, and thus as soon as the thing goes down, they sell it off immediately too, and that causes more selling. So you could say any one factor is causing the crypto drop, but it does tend to follow a lot of what's going on in the greater financial markets. As much as people like to say that uh, it's not correlated, it's pretty correlated to what's going on in the greater financial markets. It seems, at least right now, kind of in a very short term window. Now, long term, it's probably not because it's risen so much. But once it kind of finds its stable point, if it has one, it tends to kind of bounce around that. It seems. But again, a lot could change in crypto in a week. All right, let me go back to. We'll get back to the chat in just a second. You guys are getting me some great questions, which is awesome. I'll just wrap up this post before I forget. Is Karan's on here? Another member of Punch Card Investing. Would you add other income generating options like QYLD, which is like a covered call ETF, to the portfolio as alternative for bonds or dividend payments? I actually do have QYLD. Um, and or wait, do I have QYLD or I have the S&P 500 one? I think that is the what is that one? S&P 500 covered call ETF. I have X yield, not Q yield. Q yield is for the Nasdaq, for QQQ. And the way those funds work is they sell covered calls above the actual strike price of, or the current price of whatever the underlying index is, whether that be S&P 500, the Nasdaq, whatever. There's a lot of these sort of funds out there, and they do that to produce income in the meantime, while also having it hedges the risk a bit of actually being invested into the market, but it also limits your upside too. It's generally a way to produce income without getting too much into how options work. I do own a decent little chunk of X yield in my portfolio. Oh, not a decent chunk of my portfolio is X yield. I don't own a decent chunk of X yield. It's a large fund, but it's definitely something to look into. If in this environment where everyone's starved for yield, you can produce some decent yield doing that. So certainly something to consider. But you got to understand that you still are inherently invested in the market. So if you're not trying to do a more passive index style approach, probably doesn't make a ton of sense. You still have plenty of market risks where if the S&P or whatever underlying index goes down, that is going down too. The only difference is you got to take some income off the top, but we're not talking about a massive amount of income relative to the actual underlying portfolio size because it's a covered call, meaning that you own 100 shares of this underlying index and then you sell a call option against those shares. It's typically going to be some small percentage of the underlying value that it's being sold against. And then once it reaches that strike price, you're forced to sell the underlying stock at that price that you sold the option at. So again, trying not to get too much into options here, but yes, I do have it, and I would consider adding a lot more to it, maybe as I get closer to financial independence, or if I'm feeling like I really need to bring in more income, given some sort of debt position, then I might do that. But at that point, I probably would opt to sell off a position and then actually just pay down the debt immediately with the proceeds. I don't know. We'll see. I don't think it's really a long-term play for me to keep money there, but again, we'll see what happens. A lot will depend on interest rates and kind of where you can find yield. Jelani Taters asks, what do you think of the value of Pico or PCYO stock their real estate portfolio? They have water rights and they've given a pretty clear valuation on they've given clear valuations on their water rights and then some oil wells, which I'm bothering other people about. So I guess you're not asking me about those. But they currently have about 11,000 acres, mostly in Colorado, 920 of which is in the East Denver metro area. So a very expensive real estate market. Aurora Sky Ranch is what it's called. Thought you might have a better idea on what the real estate is worth. I can't find a solid answer. So I was doing some very preliminary research and trying to kind of get a ballpark answer. And where did I have it? So I went to their investor site and I pulled up their earnings presentation. I spent, keep in mind, I spent like maybe 10, 20 minutes on this, just kind of getting a very overarching broad level view and trying to figure out what this real estate is worth, mainly that kind of the 900 something acres east of Denver. But here's kind of their investment presentation as they're trying to figure out what the company is. I guess they're a water company, and at the same time, they're developing properties and they'll be servicing the water on those properties while also renting them out. So, like, I guess it's a cost-effective rental approach if they can build them at a decent price. It's a um, it's an interesting. I don't know how I feel about that because it's like they're a water company. Stay in your lane. You're not a home builder, but I don't know. It's pretty lucrative out there in Denver, it seems. Anyways, this is all about water. I guess you can see here, yeah. Build to rent segment. Sorry, this is a little small. Build to rent segment. Develop single family homes in the Denver metro area. I guess that's their plan for this lot. Uh, yeah, let's see. Land development segment. I think this is the real question you're asking, Jelani. Um, Developing nearly 1,000 acres into a master plan community. So it's like one contained sort of community, like a large development with 3,400 residential units and 2 million square feet of retail, commercial, and industrial spaces. I need to know more about the actual plans and what that's going to look like. Developing residential and commercial land for which we are the sole water and wastewater service. So that's kind of their bread and butter, it seems, is they service water. So they're really a utility company, but they have to install that too. So they're a developer and a utility company at the same time. But let's see if we can learn more about that development. So this is Sky Ranch, I guess, and they're pulling water from this place to service it. They seem to be gaining customers. They seem pretty new if they've only got 5,000 monthly water customers. That doesn't seem like very much, though. I'm not too familiar. This isn't exactly in my ballpark, water utilities. Though it seems like it'd be simple enough to do some research and learn about. I don't know. I may be speaking much too soon. Okay, land development. Here's Sky Ranch. 930 acres of the 11,000 or whatever they own, but I bet a lot of it is super cheap land, just kind of hogging the water rights or something like that. Phase one, all lots delivered, like they've already finished 509 homes. Yeah, it looks like it. They're expecting to be selling out these homes by 2021. Now, let's take a look at the value first of the stock. $336 million market cap. So that's what they're trading at. So about a third of a billion is what they're being valued at right now. And then I was kind of looking at if they're building single family homes, I wanted to get a ballpark on what the values are. Here's Denver. I just went to HomeSnap, or you can go to any of the big kind of MLS listing providers. I went to Sold, and I just looked at single family homes. It's right around here, this development. It's just south of the airport, which is right here, and just east of Denver, which is a very hot real estate market. And as you can see, homes that have sold in like the last, I think this is within the last year or something like that. This is like within the last month, the last couple of days, selling for about, these look pretty new, 500,000 here, 450. Kind of looks like the 500 to $600,000 range. And because it's further east, you might discount it a bit. So we'll just say like 4 to 500,000 if you wanted to be kind of more conservative based on current valuations. If they're building homes like this, I don't know what the homes look like exactly. So per home, I don't know. We'll just say 450 to 500, maybe 500,000 per home if they're building nice homes like these in this development. I wonder if this is from that development actually. Does it say? That'd be kind of hilarious if this was actually from this development. Oh yeah, Sky Ranch. You know what? These are that development. That's funny. That's why these all have sold. So they're selling them for around 500 a pop. That's interesting. But if it's further east at all, then huh. Okay, so the fully developed lot with a home on it sells for 500, we'll say. That's kind of our ballpark. The question is, how many homes are they actually going to build? And then also, what will those homes cost to build? And also, how many are they actually holding? Are they holding all of these or just some of these? That's what I'm a little unclear on. So I guess that was phase one. That must be what's already been selling, I think, if I'm not mistaken here. Hashtag not financial advice. I'm just doing some preliminary research here just to try to understand what they're doing. Phase two, they're trying to develop another 1,000 lots. Okay. What about the other 2,000 lots or whatever that's left over? Okay, here you go. So theoretically, once they finish all 3,600 lots, they'd be bringing in 600 million in revenue with only 262 million in expenses. So they'd be gaining. Is that? Am I looking at this correctly? So they'd be getting like 600 million. So that'd be like a $400 million NOI, I guess, their net operating income on that land, which would mean that it is. If you pull out a calculator here, we'll call it a $400 million NOI divided by I don't know, a 7% cap rate. You're telling me that's a $5.7 billion portfolio. What would that cost to build? I'm not too sure. Is this like the cost to build or the actual annual expenses per it? I'm not 100% sure here. So theoretically, once it's all built out, maybe it's worth 5.5 billion. I don't know. I think I'm getting closer to an answer to your question. I'm trying to figure out how to value this portfolio. How many are they going to own? Okay, here we go. No, that's rent. Nah. What does it cost to build these homes? That's very important. I don't know what these build costs will be. I get okay. Well, we'll say if they're selling it for, I don't know, $500,000 a pop times, I don't know. I don't know what building costs are right now because they're so high relative to, and also in Denver, it's its own market. We'll just say it costs 80% of that. They're making a 20% return on the actual build costs, or approximately 20%. So we'll say it costs $400,000 per home to build. So what was that? 80% of this $5.7 billion number would imply like $1.2 billion in equity. The $5.7 billion in total portfolio value. If I'm reading this correctly, I don't know if I am. This is super high level. But you're taking a lot of risk there. So that would be like a triple, right? From their, or a quadruple from their current valuation. Actually, yeah, something like that. But and I haven't even valued the water. So, but I mean, they're taking a lot of risk here to develop all these properties. If I'm reading this correctly, I don't know what the actual costs are. That's a super rough ballpark estimate if they're developing everything, which I don't know if they are. I think that answers the question. I'd have to do a lot more research here to see what their actual plans are. There's a lot going on. It looks like. So they've only hold on a second. They've only built 3 lots. Okay, I don't know. I take back what I said. I don't know how many lots have they actually built. They've built 3 lots. Then who's building all these? Who's building all the ones they've already sold? How much are they keeping here? Are they keeping anything? They have their water revenue, of course, which is important, but I don't know how to wrap my head around what they are actually keeping. I would need a lot more information here. So that's my stab at your question, Jelani. I think it's interesting. I'm definitely interested in this. This is an interesting model where they actually service the water, but then keep the property too. So it's like a low cost sort of approach to landlording residential properties. It could be really interesting. And in a hot market like Denver, you wouldn't expect prices to go down too much, but a lot could happen with a little interest rate change with residential real estate in particular. Oh yeah, they're saying a $450,000 estimate per property, so that's pretty close. I said around 500, 450 to 500, I think is what I said. So there you go. They're guessing 450, but they're also factoring in appreciation, which I don't like doing because you never know when appreciation stops because of some weird policy or interest rate shifts or something happens in the market. A lot could change that. So it's dangerous to rely on the market for your returns when well, I shouldn't say that. The market produces your returns ultimately, but you want to make sure that your property is decent day one and that you could at least weather a storm if you don't get that appreciation. It's really what I'm trying to say. Estimated construction of 12 homes per year. So they must not be making that many properties themselves. They're not making thousands. Uh, and I don't know how many houses are in double lots, triple lots. It's probably way less than 3,000 homes. It's got to be way less. Yeah, I'm gonna step away there before I just start talking in circles, before I know enough about this company. So that is what I would say there. Good question though. I hope that answers your question, Jelani, a little bit, or at least where to look next. It seems like there's kind of a lot to unpack there because it looks like a lot. There's a lot of moving parts there. And I want to make sure I know what their actual rights are. What do they own versus what have they given to a developer? Uh, yeah, that's what I'd want to know first. Interesting opportunity, PCYO stock. All right, back to your questions in the chat. We had some good ones earlier. Saw some kangaroo burger comments from Tom. We were talking about that on Punch Card yesterday, or yeah, it was at the towards the end of the show. We kind of went off the rails talking about kangaroo meat because Frank, investing with Frank, he's from Australia, so we're talking about wildlife there. Anyways, Brad, another question, another good one. How will you handle inheritance to your children? First off, I have to have them, which I do plan on doing at some point within the next, we'll just say conservatively 7 years, but it probably will be within the next 5. It kind of depends. Really, our ultimate goal is to reach financial independence first before having kids, which would be great because then we have a lot more flexibility. Though things can change, of course. So, anyways, once we have kids, I really am not interested in giving them a large inheritance. I'm absolutely terrified of creating like an entitlement thought in my kids' brains, which is the hardest thing to shake. Because like I've been victim to it too. I grew up in a very comfortable household, and when you're a kid, like when you're surrounded with privilege, it's very hard to recognize that you actually have it. And then by the time you're out of it, you might be in trouble. And I want to do everything in my power to prevent that from happening within reason. I think if there's any sort of inheritance or control that my kids would get, it would be like on a foundation, or a charity or something like that, a family foundation sort of thing. That's what I would picture. And it's not to say I wouldn't help out my kids, and I very much want to teach them as much about business principles and give them opportunities to, like, if they want to start like a little business mowing lawns or shoveling driveways, I could kind of be like their bank, and I can give them, like, lend them money to go buy equipment and learn how kind of like a basic business structure would work. I think that is the most I can do, the most value I can create for them. Whereas just giving them money and promising it to them when they turn some age, when I die or something like that, it's very dangerous because they might make very different decisions that might not be as productive as they could have been, um, just because they know they have money coming, which is very dangerous. Uh, I think Bill Ackman actually said this. Saw it in an interview some time ago. He's probably from a couple years ago. His dad was very wealthy. He is now wealthy. Bill Ackman is, and they were talking about inheritances as well. It's like, were you ever promised an inheritance from your dad, who was a successful real estate developer? I think. Um, so if I'm a successful real estate developer, maybe I could be like Bill Ackman's dad. I don't know. That would be kind of interesting. Um, we'll see what the future holds. But anyways, his dad said, um, "I will only give you money if you don't need it," which I thought was super interesting, like implying that he's giving it for charity or something like that. Like, hey, Bill, hey, son, here's $1 billion to put towards your foundation. It's not actually going to help the person, or like, let them spend it on whatever they want. And that's an approach I think would be really, really awesome if we can get to that sort of position. Um, Either way, I need to be clear with my kids that, like, I never want to have them guessing what they're going to be getting. That'd be even more unproductive. I just want them to know, like, hey, here's what you can expect. I'm going to be blunt. Like, um, you might get this. You're not getting this. I'm hesitant on if college is the same as it is now. I'm hesitant on just bankrolling the entire thing or something like that. I want them to have some skin in the game too, and make them really make sure they're making the right decision and do some sort of evaluation work, I guess, on whatever their decisions are. I mean, parenting is difficult. There's no perfect answer. That's kind of my general sort of framework years ahead of actually becoming a parent, if all goes according to plan. Um, that's sort of the approach I'd want to take. Definitely want to instill entrepreneurial values as much as I can without just being like full on brainwashing. Whether they become entrepreneurs or not, I can't really control, but I do want them to at least understand the principles of leverage, of taking risks, of trading your time for money versus building a business, and the different trade-offs there. A lot goes under the radar with those sorts of lessons, and if you don't make an active effort to teach kids about that, you risk them never learning about it, and I think that is a major drawback. Um, so great question, Brad. I I will leave it there. There's tons to talk about with, what is the appropriate way to raise kids. Everyone will have their own opinion because everyone's only had one chance to grow up, and generally will only have one chance to be a parent with someone. So yeah, love to get your thoughts, Brad, on that. Do you plan on giving an inheritance? I think you've talked about it sort of before. Um, would love to get your thoughts in the chat if you're still here by chance. So we're nearing an hour because we're getting lots of good questions. And we got a lot of comments about kangaroo burgers. CJ, good to see you here. What is your personal philosophy for portfolio concentration diversification? Before I answer this, go check out CJ's channel if you haven't already. He has a lot of good stuff on investing as well. He actually hosted over on Punchcard a couple times when we were short on members, and he graciously stepped in and provided some good value there too. So go check out his channel when you get the chance. But what is your personal philosophy for portfolio concentration diversification? I kind of was alluding to it earlier, but I think as the portfolio grows, it should probably lean more defensive. And sometimes it kind of has to, because there's a limited universe of opportunities when we're talking about a real big portfolio. So otherwise, if you're on kind of an offensive mode where you're trying to build wealth quickly, concentration is probably a better answer if you have a circle of competence that you're comfortable with. For me, I definitely am into the real estate game. I've learned a lot. I think I can create outsized returns for real estate compared to something like, investing in indexes or something like that. Not that that's not important for other parts of my portfolio. So I still have some diversification there in my retirement accounts, for example. That is pretty much all in broad indexes or indices, because in the event that I am not as good of an investor that I think I am, I don't want that to hamper my ability to retire at all by the time I'm in my 60s. So I still have that kind of safety net there. And it depends on your risk tolerance. You might throw that away and just go totally for maximizing returns, concentrating your bets into your your best thing, which can be very lucrative, but you have to be ready to face the consequences if that doesn't pay off, because there's nothing is guaranteed. Even the diversified approach is not guaranteed. That might not do well for the next few decades, especially when we get through this monetary crisis. Who knows? Nothing is guaranteed. Um, Diversification can help with that. And when I say like the diversified approach using indices, but diversification goes beyond that too. You have multiple income streams. You build a profitable business, and within that business, you have other sort of elements of it that produce their own income. You eliminate debt over the long term, so you eliminate that sort of risk. I think as the portfolio grows, you take those considerations a lot more seriously. But in the short term, when you're trying to build it, I think you should probably focus more on concentration. Again, if you're comfortable with the risks and if you have a particular skill that you can leverage in some way. Good question. Cabbage Eat asks, "How am I informed about informed about Evergrand?" I first heard about it, I think through I forget where I first heard about it, but I follow Patrick Boyle's channel. He has a really fantastic channel where he um, gives a lot of good, in depth, but still very entertaining breakdowns on a lot of things. He has a series on Evergrande going right now. Um, his focus tends to focus a lot on kind of frauds, big blow ups, bankruptcies, very interesting stuff. Especially coming from like an investor standpoint, seeing what causes companies to fail, maybe what to look for, or just simply being entertained by these crazy stories. Is some documentaries on like Charles Ponzi, for example, and other billionaires who went bust. Is that as well? So lots of good content over on his channel, and he's a great guy too. I've talked with him before, and a very nice guy and very smart, of course. So that's kind of where I got my initial sort of overview, and that helped me to articulate a lot of things as I've come to learn more about it, because it is a very interesting situation and certainly very concerning, to say the least, not just for China but for the broader world economy, because it's such a big engine for growth globally right now. Always looking for more sources, of course. I've been learning about cricket from Tom and Frank. So I'm a big baseball guy. I love baseball. I often will go and hit in the batting cage that happens to be by me over on the beach that I took that initial picture from, or very close to it. Um, and I'm trying to like learn about cricket, and it's like trying to unwire my brain from baseball a little bit. But I'm getting the jargon down. I'm no expert by any means, but I think I'm better than like 90 to 95% of Americans at this point, which is great. The more you know. And if I ever go visit Tom and Frank down under in New Zealand and Australia, respectively, then I'll have more to talk about with them, more local things to talk about. Chris, oops, sorry, hate hitting my microphone. It's very easy to do if I move my arms around. Do you have any recommendation on how not to focus too much on your finances? Ooh, I don't know if I have too many recommendations because I focus a lot on them. Um, Recently, I've been struggling with thinking about it all day long, checking investments each day, markets. Okay. Um, so the short answer is discipline, but like that's not a very helpful one. May, Maybe it's somehow channeling the energy towards a particular part of your portfolio. Like for example, I do my monthly net worth updates, and seeing that I'm making like progress each month towards paying down debt or adding to investments. That's I think useful. Um, but what kind of like daily checkups? Yeah, that can get pretty exhausting. I'll typically check my stock portfolio once every few days. Um, Mainly for frankly mainly for content in a lot of ways, uh, but also to see if anything's fallen under a price that I'm trying to get it out. How do you not I'm trying to find a good answer here. I think it's just channeling it towards something where maybe you can actually provide value by paying attention to it. though that's often not the case, especially with like short-term stock movements. All I can say is automating as much as you can, which is always a generic financial answer. Have money set aside that goes automatically to your brokerage account or something. Uh, Maybe you set a rule that you like can't trade a stock within a week or something. Like you vow to hold it for a week, and then maybe by the time that week's over, you'll be like, okay, it's I've seen it go up and down for a few days now, and I can get more comfortable with that. Something like that. I don't know. Uh, there are some ideas. Uh, that's all I can really say. Yeah. Well, whatever you can to like kind of build some discipline and telling yourself that you're constantly making progress each day, as long as you do believe that you're putting your money into decent investments. If you don't, then change that first. That might help. But just focusing on the bigger picture, I'm putting money into these accounts. I'm adding to my portfolio. I'm working towards debt pay down. I think that's really what you just got to primarily focus on. If you're not focusing on that, then yeah, you're going to focus on the kind of the micro movements every day, and that's just going to be very exhausting. And your Bitmoji looks awful lot like mine as well. I will say. Alfredo says, just to let you know that your content reached Colombia. Keep going. That's pretty cool. I love the global reach that YouTube has. It's very cool, especially over on Punch Card where we have literally four different countries represented between five people. Like it's cool, and our audience is even more diverse. It's super cool to have this sort of broad reach. So thank you, or gracias. And what's the I think it's K Mas. I think that's the greeting that a lot of Colombians use. That's like "What's up?" What more is the direct translation. Um, but thanks for stopping by. I appreciate it. Ooh, Cabbagey, another good question. Why did you go for law and not finance? Well, funny you say that because I did go for finance and basically got shut out because people were like, "Hey, we see your resume here. Um, uh, it looks like you did mock trial. You're just going to law school, aren't you?" And it's like, uh, um, okay. So I applied to like probably 100 analyst spots and got none. I got a decent amount of interviews, but everyone just was like, "Hey, um, Tom, what are you doing? Is this real, Tom? Tom, get off this chat. I'm gonna delete these chats real quick. Sorry, Cabbage. Tom's being immature. I'm gonna put Tom in timeout. What? So I think Tom might have been hacked, or it might be a. Sorry, this is going off the rails all of a sudden. I'm putting user in timeout. He's blocked for 5 minutes. That was something. Anyways, back to this question. I applied to a bunch of analyst spots, trying to get into like a real estate investment firm or something like that, and that way I could like learn a lot more about like due diligence and kind of the numbers behind property. Um, since I got pretty decent with Excel in undergrad, and that was kind of the pivot I made. I discovered real estate, I discovered that was kind of like what I really wanted to do in college. So I was already kind of on the law track. Eventually, it got to the point where okay, it was like okay, I got basically no finance offers. I landed a property management job right out of school. Uh, but I also around the same time I got that job, I got a full ride offer to the law school I eventually went to, which was Chicago Kent. So that took a lot of the risk out of the situation. And best part is I could take classes at night while I worked during the day in property management. So I had a full time salary, but I was also working towards my law degree, which worse if worse came to worse, it wouldn't add any value. And it's like okay, at least I have a law degree. I could become an attorney if I wanted to. Um, and it was kind of like a backup plan was my thinking. But as I went through my first year of law school, there weren't a lot of opportunities, or at least I didn't see many within the property management job I was at. So I left that when I had another opportunity pop up through a connection I had through school, actually. Who used to be involved with the real estate club I was in. He ran a commercial real estate law firm. Said, "Hey, you want to come work for us for the summer? I know you're in law school. I don't know if you're interested in law," because I had kind of given him both answers. Like, yeah, I kind of want to do law. I kind of want to do finance. I don't know. It's kind of had one foot in each bucket. Finally, just was like, all right, I'm just going to commit to law. Get into real estate law. That probably fits my skill set a bit better, anyways. Um, and I had that opportunity. From that opportunity, I got the offer to go to the firm I'm at now, which is a larger firm here in Chicago. So, and that's also in real estate law. So I had a couple good opportunities right around the same time, and I just committed to real estate law at that point because it was like, okay, I'm not going to just let these opportunities go by the wayside. It seems like this could be really good for my kind of career growth, my career trajectory, and rather than trying to spin my wheels and try to find an analyst spot, which hasn't been working anyways, because they were all turned off by the fact that, oh, you're just going to become an attorney. Well, sure enough, they kind of forced my hand there to become an attorney because that was the opportunities I was getting. So yeah, that's what I'd say there. I initially was kind of going for the finance route, trying to get into like a real estate developer or something like that. And now I work opposite real estate developers, either as their attorney or as the opposing counsel on those deals. In working through real estate transactions. So I'm seeing a lot of the same stuff. Maybe not doing as much as maybe the research or due diligence, but once the deal is in hand, I'm working through title documents, loan documents, looking at survey, like just I'm seeing all the stuff that goes on in real estate, just more from the legal lens. So I'm still learning a lot there, and seeing how parties negotiate with each other, terms and contracts that they might want to put in. And some of this is very helpful for my own real estate investing journey and perspective, and getting very comfortable with closing transactions and all the different requirements you're going to need and different municipal things you might have to keep in mind. So I'm already gaining a lot of really useful perspective outside of my legal career, but I'm also building my legal career at the same time. So it's like it's a win-win for what I'm trying to do. So that is my answer there. Appreciate the question again. Cabbage eat. Couple more questions. Best book I've read this year. I haven't read too many books this year because I had the bar exam in the spring. I read One Up on Wall Street. That was good. I haven't read very many others. I read all the Barbary bar review books, which were dreadfully boring but useful. Uh, the book on estimating rehab costs, one of the bigger by Jay Scott, one of the bigger pockets books. That's a pretty good one too, just for like a high level overview on how to quickly analyze rehabs. Are those the only books I finished this year? They might be. I do so much reading for work now. It's like I prefer podcasts at this point. I was when I was in starting law school, and I had long train rides before I actually moved into my own place. I was commuting from my parents' house in the suburbs, and it was like an hour, 20-minute train ride. So I was reading a book a week, really more like a book and a half a week at some points, and it was awesome because I was just reading all this great stuff. But yeah, I'd say One Up on Wall Street would probably take the cake this year. And once I start getting a more regular commute going down back to the office, I'd probably get into reading a bit more because I do like it, and there's a lot of good stuff there. I was keeping like a log of all the books I read so if I want to make recommendations in the future, or if there's a book title I just couldn't remember for some reason, kind of like giving a rating, like books I would recommend, I'd highlight, books I wouldn't, I would like cross out or something like that. I got to get back on that because that was a lot of fun in a very nerdy sort of way. One Up on Wall Street, final answer. I'll probably have some more books by the end of the year. Oh, Principles by Dalio. I read half of that. I need to finish the other half. That one was good for the first half. I didn't stop because it was bad. It was really because the bar review was starting. So I need to get back on that. Thank you, Chris. Likewise, wishing continued gains on your journey as well. And it looks like that is it. We had Tom's hacked account going on a rant all of a sudden. So that was interesting. Otherwise, tech got a buzzer beater question. I'll go ahead and do it. And this will be the last one. Would you consider investing in any startups? And if so, which industry? Let's see. I like counting my own real estate business as a startup, but like that's kind of I won't repeat that one. What I think you're really getting at is like private equity, getting in other people's deals. Maybe not yet. Um, if I were to do it, I'd probably want actual control over it. But in that case, I'd need to bring some sort of value. And if I don't have a bunch of connections, or if I don't actually have the actual skill needed for this thing, then it probably wouldn't make sense. And my skill set tends to be in real estate. So maybe another real estate startup, a partnership with someone else, a development company or something like that. That could be very fun. And that's not including like my own, which would be kind of the top priority would be building my own real estate startup, or this YouTube startup, if you want to call that it too. That's really what I'm focusing on now. Um, I think the amount of money, I think startups are really, if it's not your own business you're controlling, first off, you need to be an accredited investor in many cases to actually invest in a lot of startups. If you don't know the people personally, um, if they're not publicly traded, of course. But if at that point you're not a startup, uh, so yeah, that's kind of what I'd say there. It's there's definitely opportunity there. I think maybe longer term, when I have a lot more disposable income, or just money to invest, and I want to diversify a bit, try to create outsized returns that way. Once the portfolio becomes large enough to where the extra 5%, uh, or to where the universe of opportunities gets smaller. But I mean, we're talking if this portfolio gets huge, that's when it would make a lot more sense, I would think, to throw some money at startups personally for me, because otherwise I'd rather just invest in my own business, rather than give it to someone else. Whereas with the public, you could say the same about larger public stocks too. Same sort of thing. I still would prefer to put more money towards my own ventures, and the reason I have my stock portfolio generally is as a vehicle to then invest in real estate and that sort of stuff. So I could leverage that portfolio and then go into other deals. Um, that's kind of how I view my stock portfolio. So yeah, that'd be my question there. In which industry? Yeah, I'd probably lean towards real estate naturally, but it would kind of depend on the opportunity. There's a lot of interesting things out there. Okay, quick one for Brad. Which social media platform do I have the most connections? It's got to be YouTube at this point. I'm at 2,300 or something like that. I don't think I probably have like 1,000, maybe 2,000 Facebook friends. I don't think I have that many. I guess I could check real quick. Same goes for LinkedIn. Probably about the same as Facebook. But yeah, it's got to be YouTube at this point, which is kind of neat. um, let's see, how many Facebook friends do I have? 790. Don't even have 1,000. Um, And then LinkedIn, I think I don't think I have 1,000. I'm just checking because I'm curious now too. Just says 500 plus. It says about 1,000 results. So we'll say I have 1,000 LinkedIn connections, but I try to be pretty intentional, like people I've had a conversation with or something like that. Whereas YouTube, I mean, come on, come all. All right, I'm gonna wrap it up there. Otherwise, this will just keep going on for a while, which is great. I enjoyed it a lot, but I have to get going. We got a birthday party for some friends to head off to. My wife and I will both be going, which will be fun. And before I do that, I got to wrap up a couple things for work too. Got to get a couple weekend hours in, but just got to wrap up a few things. Nothing too crazy. Otherwise, thanks everyone for stopping by. I definitely enjoyed doing these live stream Q and A's. If you, be on the lookout for a future community post if you want to get your question on there at some point. And I'll be sure to incorporate that question into a future Q&A. Otherwise, stop by when we're live, and that would be great too. I always try to answer your questions in the chat too. But smash that like button, subscribe if you haven't already, since then you won't miss any notifications for those posts or for actual future episodes too. And I also put out new content every single week. If you're new to the channel by chance and did not know that, I put out new videos every single week about personal finance, investing, real estate, all that good stuff. So be sure to subscribe. Very much appreciate it. But until next time,